Okay, introduction to finance. Finance, I told you, it is the study of how and under what terms the savings are allocated between the lenders and borrowers. So borrowers. So how the finances or how the funds or how the money will be allocated between the people who need the money and who require the money कि हम लोगों के दरमियान कैसे पैसों को जो है वो allocate करेंगे. I allowed you Afnan already. वालेकुम अस्सलाम. मैंने आपको already allow किया हुआ है. So finance actually it is different from the economics in that it addresses only the resources are allocated, but also under what terms and through what channels. जो भी जितने भी हमारे पास resources हैं, funds actually not only mean a cash. Fund includes the money plus the loans or credit. Loans or credit are also the part of these what funds, yeah, or finance. So finance include the cash money plus any financial contracts or securities. So if they are transferring from issuer to the buyer, so what are the terms and conditions? What are the procedures? What are the ways? So these securities or these contracts are issued and then performed by the either party. So this is the concept of this what finance. From where we will be getting the money and how this money will be utilized and how this money will be moved on to the people who need this money. So that is called finance. That is called what? Finance. So actually the study of finance is consisting of three things. The one is called securities. The securities actually these are the documents. These are just a piece of a paper which are representing a contract to receive a money in the future, to make a payment in the future. That is called a security. And securities like a shares, bonds, debentures, bill of exchange. So these are the examples of this what securities. And corporate law. So corporate law actually these are the laws, these are the rules and regulations which are made by the government to regulate the issue and sale of securities. These are the rules and regulations which are made by the government. So for the purchase and sale of securities, so that is called what? Corporate law. For example, here in Pakistan, we have a Companies Act 2017, and there is also an organization, Security Exchange Commission of Pakistan. So who is regulating the all issuing, buying, selling, and exchange of securities in Pakistan. And the third one is financial institutions and market. Financial institutions and market actually, so these are the institutions or markets so which are involved in the transfer of funds from one person to another one person. These are involved in the transfer of funds from one person to another person, like banks, leasing organization, banks, all types of banks are there, and markets like exchange, money exchange market, stock exchange market. So all these are the examples of this what? Financial institutions or markets. Actually, these financial institutions and markets are also called financial intermediaries. Financial intermediaries. Actually, these are the organizations or companies who are meeting the gap between the people who have a surplus money and the other people or organization who need the money. So these are between these two types of peoples. So that is called financial institutions and markets. Similarly, we have two types of assets there. One is called real, another one is financial asset. Real assets actually these are tangible things owned by the persons and businesses have a physical existence. Real assets have a physical existence and they're tangible means touchable. We can touch them, so they have a physical existence like a property, plant and machineries, motor vehicles, factories, furniture and pictures, machinery and equipment. So these are the examples of this what? Real assets. So they have a physical existence. They have a physical existence. government how could manage how could manage strong financial how can make strong financial institutions. Actually, normally the majority financial institutions are a private institution, but all these financial institutions are regulated by the central bank. Every country have a central bank. You know, like Pakistan. In Pakistan, there is a State Bank of Pakistan. So the State Bank of Pakistan, and in other countries like in Afghanistan, there is the Afghanistan Bank. So these central bank are managing and controlling the all financial institutions, the all financial institutions like a leasing companies or financial institution like a banks. So all these are regulated by the State Bank, and there is always a monetary policy issued by the central bank of that specific country. So this monetary policy is being used to regulate and to control the financial institutions of the country there. Okay. So this is the purpose of these what financial institutions and how these are controlled and regulated by the government. So central bank is the major institution. So major bank, so that is regulating the all financial institutions. So similarly, we have a real assets and financial assets. So real assets, whatever they have a physical existence, so they are touchable like a residential structure and properties, major appliances and automobiles, office, towers, factories, mines, machineries and equipment. These are called real assets because they have a physical existence. We can touch them. So these are called real assets. And other one is financial assets. These are also the sources of funds or finances. So the financial assets don't have a physical existence. So they are just a piece of a paper or a contract or an agreement like a consumer credit. Whenever we are going to purchase a goods on a credit, so look here. So only the purchase invoice is a what, and purchase invoice is a what, financial asset for a person who receive a money and who have to pay the money. So the financial liability for that person. Similarly, the loans, mortgages. So Zulkarnain, you raise a hand. Any question? So consumer credit, loans, mortgages, shares, bonds, debentures. So these are the examples, securities, bill of exchange, notes receivable. So all these are the examples of these what financial assets. All these are examples of these assets. Okay. So in any organization, so we have two types of assets there. One is called real assets and other one is called financial asset. Real assets have a physical existence, but on the other side, whenever any goods are sold on a credit, any shares are issued, or any other things, or any documents are issued, any amount or contracts are made, agreements are made. So these are called our financial assets. If receivable by an organization, so then these are called financial assets. And if payable by an organization, so then these are called what? Financial assets. So this is the difference between real assets and financial assets. Okay. And financial system. So what is a financial system actually? So in the financial system, actually, we have there is the three parties involved there. The one is a household, and the second one is a business, and the third one is a government. So in the financial system, actually, the major part of the financial system is households. So they are the primary provider of the funds to the businesses and the organization. Actually, the funds are needed by the businesses to carry on their organization more efficiently and for their expansion in the business. And government need the funds to make the expenditures for the public welfare, for the welfare of the society, for to meet the development expenditure, administrative expenditure. For this purpose, government need the money. So who are providing this money? The households. How are households providing the money? Actually, they are making the savings. If, for example, if a person have a 50,000 earnings per month, and out of 50,000 they are spending, he is spending, for example, here she's spending 30,000, and 20,000 they are saving and depositing into the bank account. So this 20,000, whatever he or she is depositing into the bank account, so this 20,000 is used by the business organization or by the government. So they are taking the funds from the banks, or they are using the funds and taking funds from the bank and using for their respective purpose. Okay. So normally the financial institutions are working as a financial intermediaries. So financial intermediaries, so these transforms the nature of the securities they issued and invest in banks, trust companies, credit unions, insurance funds, mutual funds. So market intermediaries, normally we have a investment dealers and brokers. So we have there are the financial intermediaries. Another one is what? Market intermediaries. Financial intermediaries, normally the banks, trust companies, credit unions, insurance firms, and mutual funds organization. So these are called financial intermediaries. So take the money from the households, individuals, and then they make the investment of this money to the other organization in the other purpose. Okay. There is another one, intermediaries. Those are called market intermediaries. So they are getting money from the households, and then they are making investment in the securities or in the shares, like investment dealers or brokers. So normally these investment dealers and brokers, so they might be working in the properties or might be working in the shares and the bonds, buying and selling of shares and bonds. So this is the concept of financial intermediaries and market intermediaries. Actually, look here, in the financial system, on the one side is households, and on the other side, the households, these are the people who have a surplus money. Households, so these are the people who have a surplus money. On the other side, there are three other types of people or organizations who need the money. For example, government, businesses, and non-residents, mean outside the country. So we have two types of intermediaries between these two. So one is called financial intermediaries. Another one is what? Market intermediaries. Market intermediaries. So these financial intermediaries and market intermediaries, so they are creating a link between the households and government, businesses, and non-residents. These financial intermediaries, so they are taking the money from the households and transforming the money to the people who need this money, like a government need the money, businesses need the money, and if there are any non-residents, so if they need the money, so they are transforming and transferring the money from the household to the people or to the organizations who need the money there. Okay, so this system is called what? Financial system. This system is called what? Financial system. सबको मेरी आवाज स्लो आ रही है? And in the financial systems, all of you को मैं को slow आ रही है, बाकी को I think from my side the internet is okay. If internet is giving the problem from my side, then I can see the signal on my screen. The net is slow. Okay, so there might be problem on your side for due to the internet. Acha, in the internet, in this financial system, so funds can be channeled from the saver to the borrowers in the three ways. इसमें हमारे पास तीन तरीके हैं, जिन तीन तरीकों से the money from the savers can be transferred to the people or to the organizations who need this money. The one is called direct intermediation. Direct intermediation. Direct intermediation means, so there might be a direct transfer from the saver to the borrower. This is called non-market transaction, we call it. For example, let me tell you, for example, you have a surplus money and I need money for my business for any other purpose. So whenever I'm directly contacting to you to get the money for a credit purpose on a loan, so this is called direct intermediation. There's no intermediation between that. So this is called direct transfer from the saver to the borrower, who have a surplus money and who need the money. So they have a direct relationship with each other for the purpose of a transfer of money from the saver to the borrowers or to the person who needs the money there. This is called direct intermediation. So this is, it is a non-market transaction, and in this market is not involved, because directly I'm getting a loan from you and I'm using this loan for my any purpose, might be used for my personal purpose and might be used for my business purpose, whatever purpose is there. Okay. The second way is direct intermediation, but there will be a market-based transaction. Market-based transaction means, so there might be a one person between you and me, and that person might be a broker. That person might be a broker. So you are not directly contacting me. For example, you have a contact with the broker, then I have a contact with the broker to receive the money. So this is called market-based transaction. Actually, money will be moving through the market there. Okay. So first you will give the money to the broker, then the broker will give the money to me. So this is called direct intermediation, but market-based transaction. But market-based transaction. And the third one is indirect intermediation, indirect claims through a financial intermediary. Financial intermediary means, for example, you deposit the money in your bank account, and whenever I need a money, then I will take a loan from the bank. I will take a loan from the bank, from the financial institution. So this is called indirect claims through financial intermediaries. Indirect claims through financial intermediaries. So we have these three ways through which the funds can be transferred from the savers to the borrowers or to the persons who need the money here. See here, there are two persons. The one is lenders. Lenders mean the people or persons or organizations who have a surplus money, who have savings, and who want to give the money to the other people on a loan, on a credit. So these are called lenders. Borrowers. So these are the people or organizations who need the money. So in this, the first one there is, we have a direct, look here, market intermediations. There is market intermediation and non-market transaction. In case of a non-market transaction, so lender or borrowers will be directly contacting with each other. But if there is a market intermediation, so in the market intermediation, there will be a one person between them. So that will be a broker. And in case of the indirect claims, so there will be financial intermediaries. There will be financial intermediaries like a financial institutions, like a banks, insurance companies, banks, mutual organizations. A number of companies are there, leasing companies. So these are called what? Financial intermediaries. So these are the channels of intermediation. These are the channels of intermediation. Channels of intermediations mean how the funds will be moving from lenders to the borrowers. What is the procedure? What is the way? And what is the process to transfer the funds from the lenders to the borrowers? So this process is called what? Channels of intermediation. Channels of intermediation. Okay. Next is financial intermediaries. So the major financial intermediaries like banks and other deposit taking institutions, insurance companies, pension funds organizations, mutual funds organizations. So these are the different types of financial intermediaries. So these financial intermediaries are collecting the small savings from the households, and they are accumulating these amounts and then giving the amounts in the form of a loans to the borrowers. Giving the loans to the borrowers or making the investments in the projects like that. So these are the different examples of financial intermediaries. Okay, financial intermediaries. The first one is banks. What is the procedure of a bank? Actually, banks take the deposits from the a number of customers, a number of depositors across the country, and then these deposits are pooled in the bank. Bank takes these pooled funds and lends them out to the households and businesses in the form of mortgages and loans. So what is the business of a bank? So actually they take the deposits at the lower rate of interest and give the deposits to the borrowers, give the loans to the borrowers at the high rate of interest. The difference between this interest rate is the profit of the banks. The difference between these interest rates is the profit of the bank. So actually the bank transformed the original nature of the savers, the depositors' money, and to the people or to the organizations who need this money. So deposits are usually in the small amount, and these small amounts are accumulated. Then a large amount is created, and this large amount is given to the people who need this amount there. Okay. So banks can perform this transformation function because they become expert at a risk assessment, financial contracting, pricing the risk, and monitoring the activities of the borrowers. So because they have a resources, so this is the work or this is the business of the bank. So they can efficiently and effectively transforms the money from the savers in a small amount to the borrowers who need the money in a large amount who need the money in a large amount. So these are the purpose of this what uh, pooled mean combined in the lump sum amount, combined, pooled. For example, in a bank, so there might be 100. For example, there might be 1,000 customers in a bank. So these 1,000 customer, if each customer have a balance of 10,000, so 1,000 into 10,000. So then how much amount will be pooled there in a bank? So then this total amount, whatever is pooled mean combined together. So this total amount, whatever is pooled, so from this amount, then bank can give a loan to any business organization. They can make investment in the market, in the shares, in the bonds, or anywhere in the property, even they can make the investments there. So this is called pooling. Pooling means combining the small amounts and making a large amount of a funds. So that is called what? Pooling or pooled. Okay, clear this? So this is the concept of banks. And there is another one organization, that is insurance companies. If you people are familiar with insurance companies, so insurance companies actually they are selling the policies, life policies, and sometimes they are providing a security to the transfer of assets from one place to another place. For carriages, they are providing the insurance. So they are selling the policy and collecting the premium from the customers based on the pricing of those policies given the probability of a claim and the size of policy and administrative fees. So then these, this insurance policies, so they are collecting a small amount of premium. Then these small amount of premiums are accumulated, and they are accumulated and pooled into the large amount. And then these large amount are given sometimes as a loan to the other peoples, are made as an investment in the other companies, in the other organizations, like this way. Okay. So insurance allows household businesses and government to engage in risky activities without having to bear the entire risk of the loss themselves. So insurance company also take the risk of the households and other businesses on the basis of a minimum premium. So they're taking the burden of a risk on themselves, and giving a risk-free business and environment to the households and business organizations. So this way, so the funds are transferring from the individual households to the society, to the market, to the people who need this money or who need these funds. So this is another organization, is the part of financial intermediaries. So these are called insurance companies. And the third one is pension plan. I said pension organization. Actually, these pension organizations, these are working for the company's employees. So they are providing the pension payment plans for the employees of an organization. So they will be getting the contribution from the organizations, from the employees, and some amount is contributed by these organizations. They are making investment of these cumulative amounts and funds into the investments, into the shares, and at the end of the specific period, then whenever any person is retiring from an organization, then the pension amounts are paid by these pension organizations. Actually, they are multiplying these amounts. If, for example, you deposit a 1,000 per month into a pension plan, 1,000 is deposited by your organization. So when this 2,000 per month is put into a pension plan, and this 2,000 is invested by the pension organization into a different projects, then this 2,000 will be multiplying over the period of time. So after a 1 year, 2 years, 3 years, 4 years, or 10 years, so whenever an employee is retiring from the organization, so there will be a large amount of funds accumulated in his account. So that amount will be paid by these pension fund organizations. Pension fund organization. So these pension plans accumulates a considerable sums of money, and their managers invest those funds with the long-term investment time horizon in diversified portfolio of investment. Diversified portfolio of investment means they don't make the whole amount in a one type of security. So to make an investment of these funds in a different investment. Some amount might be invested in the properties, some might be invested in the shares, some might be invested in the other business organizations like this way to minimize the risk or to reduce the risk. Okay. Research and fueling. These investments are major sources of capital. For example, fueling investment in research and development, capital equipment, resource exploration, ultimately contributing in a substantial way to growth in the economy of the country. Okay. So these pension fund organizations are very much important for the employees and employers also. For the employees and employers also. So this is another one, financial intermediary. Okay. There is another one, mutual funds organizations. Mutual funds give small investor access to diversified, professionally managed portfolio of securities. Actually, these mutual funds organization, they normally make investment in the shares and bonds or debentures. They make investment in the securities of other companies. So whoever are the members of these organizations, so they give the money to these mutual fund organizations, then these funds are used by this organization to make investment in the securities or shares or bonds or debentures of other companies. Okay. So they buy the shares or bonds or debentures of other companies. So whenever the value of those shares, whenever the value of those securities are increasing, they will sell in the market and they will getting the gain, or they sometimes they will be getting the profit on those securities like this. Then that profit will be distributed among the members of these mutual funds organization. Members of these mutual fund organization. So this is called small investor often do not have the funds necessary to invest directly into the market traded stocks and bonds. Actually, in normally the individual don't have an idea about the stock exchange. They don't have information about the markets. So they can give the money to these mutual fund organizations. Then these mutual fund organizations will make the investment of their money into the stock exchange, in the securities, in the shares, in the bonds or debentures. So whatever the profit or gain is arising on these securities, then that profit will be distributed among the members of these mutual funds organization. So this is another one, financial intermediary in case of this mutual fund organization. Diversified mean into a different types of securities. Diversified mean into different types of security. For example, they can make investment in the shares of a, for example, textile industry. Some investment might be made in the sugar industry. Some investment might be made in the education industry. Some investment might be made in any other service industry. This is called diversification. This is called what? Diversification. Diversified investment we call it. Okay. Diversified investment. Don't put your all investment in the one company, because if one company is failing, so then your whole investment might be lost. And if you are going to make investment of your money into a number of companies, if one company fails, so the other company might be successful and will be giving you a profit. Okay. So this is the concept of portfolio, or we also call it diversified. Diversified. Securities, actually, these are shares, these are certificates, these are documents. That is called securities. And industry mean companies or organization. For example, let me tell you, where in Pakistan, textile, the one textile sector is a textile industry. And there's another type of the all companies in the textile is called what? One industry. Textile is a one industry, okay? Similarly, there's another one, sugar factories or sugar mills. So the combination of all these sugar mills or factories is called what? Another industry, that is called sugar industry. You know, sometimes we say that film industry. So look here, this drama industry, film industry, fashion industry. So everyone different from each other is called what? An industry. Industry means a number of companies having a same business in the one sector, that is called industry. Okay. So whatever shares or bonds or debentures, whatever security documents are issued by these companies, so those documents are called what? Securities. Those documents are called what? Securities. Whatever shares issued, shares are called securities. If bonds are issued, bonds are called securities. If there are any other bill of exchange, is a security. So these are the examples of securities there. Okay. Clear this, Afnan? And there is major borrowers. No, who are the people who need the money? Who are the people who need the money? Who are called borrowers? Who are called what? Borrowers. So major borrowers, the first one is public debt, another one is private debt. Public debt means, so these are the loans, these are the funds, these are the amounts which are needed by the governments. You know, if you people know, a large amount of loans are taken by the government from the local financial institutions, from the local financial institutions, and even they are taking the debt or loans from the international financial institution for the purpose of the development projects and for the purpose of administrative expenses of the government. So we have a federal government need funds, provincial government need funds, then the provincial government have a municipal corporations, organizations, the crown organizations or corporations. So these are the different types of uh, governments which they need, who need the money. This. There is another one, private debt. So private debt is need by the households. Households normally they need the money for the purpose of education of their children, for the purpose of making a houses or homes, for buildings. For this purpose, they need the loans there, or they need a loan for the marriages of their children. For this purpose, they need a loans households. Another one, non-financial corporation like a non-profit organizations. NGOs might need a loan to carry on their activities, their business activities, or their non-business activities, or for the welfare of the society. So these are called non-financial corporations. Okay. So these are the private debt, or business organization are also coming. Private business organizations are also coming in the private debt. So similarly, there are two major categories of financial securities. Now, we have a two types of securities. Security is what? Actually, it is a certificate, it is a document which is representing a money, which is representing a money which can be sold in the market, which can be exchangeable in the market. So that document is called what? Security. Remember this. That document is called what? Security. Debt instrument and equity instrument. Whenever a certificate or whenever a document is issued for the purpose of raising loans, जब आप कर्ज लेना चाहते हो, कर्ज लेने के लिए अगर आप कोई डॉक्यूमेंट इशू करते हो या कोई पैसा piece of paper if you are going to issue, that is called a debt instrument. And debt instrument like a commercial papers like a bill of exchanges, bankers bill of exchanges acceptance, treasury bills issued by the government, mortgages loan in which the documents are mortgaged or patched. These are called mortgages loans, bonds, debentures. So these documents or these securities are issued for the purpose of raising loans, for the purpose of raising loans. And equity instruments actually, so these are the certificates, these are the documents which are issued to raise the capital for the company, to raise the equity for the company. Whenever you are buying debt instrument, then you will be the lender of that company. and whenever you are going to buy the equity instrument, then you will be the owner of that company. Okay, you will be becoming the owner of that company. So we have these two types of securities here. So the one is called debt security, and another one is called what? Equity securities or equity instruments. Similarly, we have another way. There is another one: marketable securities and non-marketable securities. Non-marketable securities actually are those securities which cannot be bought or sold in the market, which cannot be purchased or sold in the market, or which cannot be exchanged in the market. For example, saving account, deposits accounts. So these can be only handled by whom? Who is the account holder of the saving account or deposits account. A third person cannot withdraw the money from these accounts. A third person cannot withdraw the money from these accounts, and these cannot be transferred from one person to another person. For example, if I have a saving account in Allied Bank, so I cannot transfer my saving account into the name of another person. My account can be closed and another account can be opened in the name of another person. Okay, then amount will be transferred from my account to another account, but it cannot be transferred, it cannot be marketed, it cannot be sold. So that is called saving accounts, term deposits. Similarly, guaranteed investment certificates, Canada saving bonds. So any document, saving account, whatever we are going to opening the account in the bank account, in the insurance companies. So these are not transferable and these cannot be sold. These are called non-marketable securities. Non-marketable securities. And there is another one, securities, those are called marketable securities. Marketable securities mean, so securities which can be sold anytime whenever you need a money. For example, like shares, bonds, debentures. So these can be sold anytime in the market. Whenever you need the money, you can sold in the market. You can sold in the market. Okay. So this is the concept of this what market. So can be traded between or among the investors.